In spite of several production and delivery difficulties, the Model Y managed to become the best-selling car overall in Europe and the best-selling non-pickup car in the US. Therefore, the Tesla team deserves a lot of credit for attaining these fantastic outcomes. Hello everyone, today we're here to discuss one of the most talked about subjects in the stock market right now, Tesla's incredible first quarter profits. You read correctly, Tesla is in flames, and I'm not only referring to their electric cars. Tesla recently released its first quarter 2023 earnings report, and the results are really interesting. In fact, it actually indicates a path for our portfolios. Now, let's get started without further delay. As everyone knows, the repercussions of the epidemic are still felt in the economy, and Tesla is not exempt. The way the business is responding to the circumstances is interesting. Finally, the reduction in vehicle pricing that they have been making may be seen on their financial statements. Now, let's examine the figures. The most intriguing finding for this quarter is Tesla's operational profits. And guess what? Not every number on the chart is positive. From $5.5 billion in the first quarter of last year to $4.5 billion this year, Tesla's gross profit has suffered. We haven't experienced a drop in gross profit that year over year for a long time. Not only that, but Tesla saw growth during China's shutdown last year. Nevertheless, this year's price increases are seriously hurting its profitability. According to financial reports, they produced an astounding $2.7 billion in operating income, which is the lowest in a long time and slightly less than what they made in the first quarter of 2022. Well, if the operating income is lower than before, why are we so excited, you may be asking yourself at this point? What? Let me tell you, though, looking forward, Tesla's profitability and gross profitability. You see, Tesla's present price is entirely predicated on the company's phenomenal rate of growth. A $500 billion valuation is justified if they can consistently generate $5 billion in earnings every quarter or $20 billion in earnings for the year and a 25 times price to EBIT ratio. The problem is that it appears that this year will be a little harder to reach the $20 billion earnings threshold. This is where the first quarter earnings report from Tesla is relevant. Even though their operating income may not be as high as it once was, their profitability and gross profit margin appear to be holding steady. This is significant because it indicates that Tesla is still developing and growing, even though they might not reach the $20 billion milestone this year. Not to mention, Tesla is constantly coming up with new goods and innovating, which raises the company's potential for growth and profitability. Now, it is a ridiculous $3.3 billion in revenue for Tesla's first quarter. Even more astounding is the fact that their operating income was a staggering $19.3. Though bear in mind, it doesn't even account for all of the price decreases that happened in the second quarter. That is the lowest it's been in 4 quarters. Thus, these figures could decline considerably more. This is when the intriguing part comes in. Even though Tesla's business plan enables them to earn from each additional $1,000 for FSD, they only receive between $5,000 and $15,000 from B. Therefore, even a $1,000 to $3,000 drop in margins can have a significant effect, which subsequently impacts their income statement. It resembles an endless circle of financial jargon. Okay, so this is what truly fascinates me. We have the impression that we are witnessing a live economic case study being conducted in front of us. Initially, I believe that Tesla would be able to absorb these price reductions with ease and that its earnings would stabilize. However, I'm beginning to believe that earnings may possibly begin to drop. When examining Tesla's operating profits annually, they made an astounding $12.6 billion last year. However, the first quarter's results indicate a lower run rate, so it's not certain if they'll be able to hit the $20 billion milestone. This is where it really becomes personal for us investors. It gets harder to defend Tesla's trillion-dollar market valuation when profits growth is unpredictable. We all believe in the company and its potential for innovation, of course, but the numbers speak for themselves in the end. Anyway, let's look at the figures from the previous year and set all those numbers aside for a moment. As you can see, Tesla's energy division generated $1.3 billion in sales, a record for the company. But guess what? They achieved an astounding $1.5 billion in revenue this year, surpassing even their own expectations. How did they manage it? With their Megapack business's phenomenal rise, they have been producing batteries at an incredible rate, reaching 3.9 gigawatt hours, and they have just constructed a new megafactory in Shanghai, which will only spur on this expansion. We're all in this for the long run, after all, so I understand that some of you may be worried about the recent price reductions and how they will affect profits. It's certainly something to watch as a shareholder. EBITDA and gross profit are declining, despite a 20% increase in sales and a 30% increase in deliveries. Furthermore, profits growth may not materialize if these price reductions persist, which might be concerning for growth stocks like Tesla. Don't worry, though, I still think highly of Tesla's long-term goals. Now, let's face it. First off, although Tesla may appear to be the least profitable and strongest firm in the industry, their first quarter results are still quite impressive. And that's terrible news for rivals such as Lucid and Rivian. Apologies, but not really, are you? However, Tesla has enough cash on hand to get through this. They will eventually be all right. It's interesting to note, though, that earnings could decline or temporarily stagnate during this recession, which would have an influence on such a promising growth story. But there are so many advantages to discuss that let's not concentrate on the drawbacks. With its Megapack division leading the way, Tesla's energy business is booming. Not to mention their incredible electric vehicles, which are revolutionizing the automotive sector. People are moving to electric automobiles at an increasing rate every day, and Tesla is leading the way in this revolution. If none of that is satisfactory to you, you should see what Elon Musk plans to release in the upcoming months. Yes, I believe the charts may soar with the announcement that Tesla plans to provide a much more inexpensive program. This is the platform that will be utilized to produce the eagerly anticipated $25,000 Tesla. You did really hear correctly. Elon Musk stated during the Tesla company's third quarter results call in October 2022 that the upcoming platform will produced at a half the cost of the existing Model 3Y platform, and we are all aware of the great success those models have enjoyed. Now, just think of what Tesla could accomplish with a platform that is even less expensive to create. To be clear, this does not imply that the new Tesla vehicle will cost precisely half as much as the vehicle 3 or Y. However, it does imply that it will be much more affordable, opening it up to a larger market. And let's face it, who wouldn't want a less expensive Tesla? However, the cost is not the only factor. Regarding production volume, the next generation platform will also be a significant advancement for Tesla. Elon Musk asserted an enormous accomplishment in and of itself that this platform will produce in greater quantities than both the Model 3 and the Y. This implies that there should be a drop in wait times as well as an increase in the number of Tesla cars on the road, and that's fantastic news for our stockholders, as we are all aware. Nevertheless, returning to the current situation, I understand that some of you may be concerned that Tesla's valuation may drop to more affordable levels. Remember that there is still a lot of space for growth and that these are still enormous earnings. Sales are also very robust. As previously said, however, we are unable to award Tesla a perfect score of 10. We have to acknowledge that the company's growth is beginning to decline. But let's not forget that Tesla is maturing as a company, and that maturity brings a more fair valuation. There's no doubting that the current state of the economy is uncertain, and this might affect the stock market. However, you need not worry. Investors should continue to monitor Tesla despite the unfavorable technical trend. The only thing we can do is wait and see. The worst part is that Tesla is a far better investment at lower prices. Therefore, if you've been considering investing in Tesla, this might be the ideal time. Anyway, gentlemen, feel free to share your thoughts on the most recent earnings call, and let's continue the conversation. I hope to see you soon for another episode. Split's EV markdown significantly reduced its first quarter earnings. The gross profit margin of the electric vehicle manufacturer fell below 20%, the lowest level since the end of 2020. What can we therefore infer from Tesla's most recent earnings report? In summary, we discovered that continuously lowering your car pricing hurts your profit margins.